If you're worried about the debt ceiling crisis and what that means for investors, you aren't alone. And as the days and weeks go by, the anxiety is only going to increase if Congress doesn't solve the problem. And if the unexpected happens and no agreement is made and we default, consumer and business confidence will suffer. Stock prices could drop, interest rates could go up, and we could see an across-the-board consumer business spending contraction. People don't like to spend money when they're unsure about the future. And if Congress finds a solution after a default, it would still be a very expensive move. And as you'll see, it possibly could do a lot of harm to investors. But the good news is, by the time you finish watching this, you'll understand what the debt ceiling crisis means for investors and what you should do about it. First, let's understand what's happening without all the jargon. When the United States spends more than it takes in, it has to borrow the difference. And we've been spending more than we take in for a very long time. And that means that we've been borrowing a lot of money for a long time. But by law, the United States can only borrow so much money. 31.381 trillion is the limit, to be exact. And our government hit that limit on January 19th of this year. That's a problem because if the government can't borrow more, it throws into question whether or not the government can carry out vital programs and pay its employees and or pay the interest on the accumulated national debt, which means the treasury securities you own, your bank owns, and foreign governments own, or pay your Social Security check. Now, that's one thing to cut back on spending. But if the government doesn't pay the interest on the debt it owes, that means we're in default. And that introduces a world of trouble that I suggested above. This isn't the first time we've faced this problem. In fact, we hit our debt limit 75 times since 1960. That's more than once a year. And each time Congress raised the debt limit. So you can see that in the past, the government has always agreed to just increase the debt ceiling, and they probably will again this year. But because neither party has a strong majority, they'll both have to agree on a debt ceiling increase. That could be a challenge. They'll each try to get as much as they can before they agree to this increase. And these negotiations will take time. You know what, before I forget to mention, please subscribe and smash the notification bell so you'll know when we release future videos vital to your future retirement security. Back to the issue at hand. I mentioned that the negotiations between the parties to work out a solution will take time, but that's okay. Because of certain measures taken by Janet Yellen, the Secretary of Treasury, we won't run out of money until June or July. So we have until then before the problem occurs, a default by the United States on its debts. In other words, think of this as a person who has charged their credit cards up to the limit and they've received an extension of time to pay. The negotiation. There's lots of noise and finger pointing going on in Washington, D.C., with each party blaming the other party for the situation. Still, despite the public acrimony dominating the headlines, moderate discussions are taking place in the back rooms of D.C. And compared with debt ceiling challenges in the past, the decision makers are actually in a better position to solve the problem now. And I say that because the economy is fairly strong. Is default possible? Yes, if our elected officials don't find agreement, default is possible. It's not likely, but possible. It's not likely that we'll default because our leaders understand that if the United States government defaults on its debt, it will degrade the value of the dollar internationally, raise interest rates, and possibly throw the entire global economy into a panic. The closest we ever came to defaulting was in 2011. Congress couldn't agree on what to do, and the stock market fell 16% in just over a month. Back then, Standard & Poor's downgraded the U.S. credit rating for the first time, and that sent shockwaves through the global system. Thankfully, the ladies and gentlemen in Washington did raise the debt limit in early August of 2011, just a few days before the government would have defaulted. Still, this impasse caused interest rates to spike, and that cost the government over $16 billion in added interest costs. The good news is that today, both parties are talking about how important it is to solve the debt ceiling problem. This is months before a default is possible, and that's encouraging. What's different this time is the very narrow majority in the House of Representatives, which means just 5 people can refuse to raise the debt ceiling. What we'll likely see is one party pass a debt ceiling increase in the House that includes big government spending cuts, and that'll be rejected by the Senate. That's when the bargaining will start and the solution will have to be found, and if not, a default will occur. Another possibility is that the 2 parties in the House and the Senate could come together and pass a solution that both houses of Congress would agree to. We'll have to wait and see how this plays out, and like I said, it's likely that it will take months before we really get a clear picture of what direction this is going in. How will this impact the market? In the past, the stock market didn't react to default problems until about a month before a possible default could occur. That's what happened in 2011, so it's reasonable to expect higher volatility in May if an agreement isn't reached by then. Of course, no one can predict the future, and the past is no guarantee of the future either. Over that period, you might see Treasury bill yields go up and bond prices go down. But that could also have more to do with overall expectations about inflation rather than in response to the debt ceiling issue. Once we get closer to the default date, if we do, you could expect bond prices to drop and then hopefully recover once an agreement is found. Same thing with equity prices. We don't know what's going to happen, but as we get closer to a default, stock market prices could be more volatile, and then they could settle down once an agreement is reached, all things being equal. Like I said earlier, the odds of a protracted default on American debt are low because of the dramatic and unpredictable ramifications. Congress has always found a way to come to an agreement on raising the debt, and they probably will this time also. However, what we do not know is the ramifications of a default, even if it lasts only a few days. Would other countries trust us in the future to pay our debts on time? We're heavily dependent on other countries to buy our debt, as they own 25% of our accumulated debt. But remember, the debt situation is only one factor that's impacting the market, and there are many other forces at work as well. Investors are looking at inflation, jobs, energy prices, interest rates, and corporate profits. These all have a much greater and longer-term impact on the market compared to concerns about the debt ceiling. But the debt ceiling impasse is the most powerful market force in the short run. Your takeaway: the odds of an eventual agreement and increase in the debt ceiling are pretty high. Not guaranteed, but they're high. But until that happens, expect volatile markets. After an agreement happens, expect markets to settle down. If that agreement includes cuts in government spending, that might be really good in the long term, but over the short run, it will put the brakes on the economy, and depending on how much is cut, it could throw us into a recession. There are too many unknowns to accurately predict what will happen, and since that's the case, I would not change my investment strategy because of the debt ceiling debate. My suggestion is, as always, think long-term and be realistic, and make sure to speak with your own financial advisor before making any investment decisions. For more ideas on how to secure your retirement future, please subscribe now to the channel and make sure to hit that notification bell. And be sure to look in the description below to this video. You're going to see a link to join our Facebook group, where you can interact with others about retirement issues. And also, we have links to our free booklets on 10 different retirement topics.